This is your LMAX Exchange technical update for Wednesday, February 22nd, 2017. Euro dollar. So the euro is finally at a critical inflection point right now on the daily chart. The question out there right now is this market seeing a bearish resumption back towards the recent 14-year low in January at 103.41, which guards against that critical parity level, or are we seeing a pullback that is going to be supported in favor of the formation of a right shoulder of an inverse head and shoulders pattern? If you look at this market, you can see that we were supported back in December of 2016 in the 105 area. And so if we pull back into this internal support and are supported above 105 on a daily close basis, we could see a bounce, which sets up this right shoulder, opening the door for an acceleration back to the top side, ultimately above 108.75 and projecting gains up towards the 113 to 114 area. Again, at the same time though, if the market establishes a close below 105, this would suggest that the inverse head and shoulders formation is not going to play out, and the market will see a bearish resumption back towards that 14-year low, which guards against that critical test of parity. So it'll be interesting to see 105 today if the market closes above or below that level for a clearer directional insight into the euro. Sterling dollar. So cable has been mostly chopping around in recent trade, unwilling to commit on a short-term basis for any new direction. On a medium-term to longer-term basis, while the market holds below the December peak at 27.75, the risk is tilted to the downside, and we could see another downside break back towards that October base, that critical plus 30-year low from October 2016 at 118.40. Right now, the key level of support to watch below, which if broken could open the door for that setback, would be 23.47, the low from the 7th of February. Dollar yen. So dollar yen has seen a little bit of a bounce in recent trade, but overall, while the market holds below 115.62, that high from the 19th of January, there's risk for the market to be well capped and for fresh downside below recent range support at 111.59 and towards a measured move at 109.50 further down. At this point, only back above 115.62 would put the pressure back on the top side. Euro Swiss. So Euro Swiss is at the end of a bearish descending triangle formation, which opens the door, or should open the door, for a break initially below the 2016 base at 106.24, accelerating declines towards a measured move objective at 105 further down. Only back above 107.60 would take the pressure off the downside. Aussie dollar. Aussie has seen a very nice run in 2017, and with the market rallying up all the way to some critical medium-term resistance in the 78 area, there is risk over the coming sessions that we see this rally eventually stall out ahead of a fresh downside extension all the way back down towards the 70 area. We would, however, need to see a break and close below 76 to strengthen this outlook and accelerate declines. Dollar CAD. So dollar CAD has been very well supported into its recent dip into the 130 area. We did see a break below 130, but the market could not establish a close below that level, and this sets up the possibility for fresh upside over the coming days back towards that recent multi-day peak at 136. Initial resistance here comes in by the high that we saw going back to the 7th of February at 132.13. A break and close above that level will strengthen the bullish outlook and accelerate gains. Kiwi dollar. So Kiwi continues with its downside pressure. The market has recently just taken out that previous low that we had seen back on the 14th of February around 71.14, 71.15, and that break does suggest that we're on the verge of seeing a next downside extension, which could ultimately take us back towards medium-term support, which comes in the form of the lows that we saw in December in the 68.61, 68.60 area. At this point, only back above the recent highs at 73.76 would negate the bearish outlook for Kiwi dollar. SPX 500. The S&P 500 yet again pushes to another record high. This market continues to trade higher, going parabolic and looking for its next key psychological barrier at 2400. At this point, a break and close back below recent support, which comes in around 2338, would be required at a minimum to take the immediate pressure off the top side. That's the low that we saw on the 17th of February. Ultimately, though, for a sort of meaningful short-term correction to play out, the market should establish back below previous resistance turn support in the 2300 area. Until then, this parabolic move, which is highly overbought, is continuing to push higher, and it has sights set on a test of 2400. Gold. So gold has been very well supported on dips in 2017, and the market now is looking for a fresh upside extension towards a measured move at 1260. At this point, any setback should be very well supported, with only a breakback below 1180 to compromise the constructive outlook for gold.